This is TreppWire Week in Review for the week ending July 21st, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, head of CRE and advisory services, and Stephen Bushbaum, research director. This week, U.S. stocks continued to surge as investors have fully embraced the soft landing deflationary narrative. The momentum from last week's CPI and PPI numbers spilled over into this week and was helped by better than expected earnings from JP Morgan, Citi, Bank of America, and Morgan Stanley. Even bad news was dismissed this week as investors shrugged off weak retail sales data and the threat of another Fed rate hike. The market seemed to have gone from optimistic to exuberant over the last 2 weeks. But Lonnie, are we approaching what Alan Greenspan once coined as irrational exuberance?
Yeah, so I'm going to have to go back a little bit. I think this term irrational exuberance came into existence around 1996. It was from a speech that then, former Fed Chair Alan Greenspan gave, where he talked about irrational behaviors or enthusiasm, psychological enthusiasm from investors that really drive asset prices higher than what those assets fundamentals would justify. And it was really interesting, the timing of his speech, because we were kind of on the precipice of the dot-com bubble. We had this run up in dot-com exposure and valuations, and obviously that popped around 1999. I definitely think there's some correlation here where we're seeing a lot of investor activity that maybe doesn't match where we are in the cycle right now. And we've seen asset values fluctuate on the high side. And even with increasing interest rates, we haven't seen a full reset in valuation. When if you look at them from a fundamentals perspective, cap rates have to be higher than they were 2 years ago. Values have to be less. NOIs are not up significantly, even though some assets have seen significant rent growth. It's plausible that we're definitely in a period of irrational exuberance. After the 1990 dot-com bubble, Robert Shiller put out a book called Irrational Exuberance that actually looked at this phenomenon, and he was part of the Case-Shiller housing index. And, the bubble that popped in 2008, I think, would be symbolic of an irrational exuberance period as well. So, I don't know that we're a textbook definition today, but it's definitely interesting to see how optimistic and, I think as Manus put it last week, risk on people have become over the last couple of weeks relative to where the fundamentals might say we should be.
So just a little bit more on that point there, Lonnie, is I think just reiterating what you highlighted, that we're in a little bit different environment today. If we think back to how stocks were traded back in the 90s and early 2000s, electronic trading really hadn't ramped up yet. So some of the flows I expect that we're seeing today are driven in part by algorithmic trading flows and momentum and all of these quantitative strategies that are getting executed. And really what's also important to keep in mind is there was a large portion of the market that had moved to cash late last year, beginning of this year, in anticipation of the most anticipated recession in history that really hasn't materialized. So some of what has transpired over the last couple of weeks, I think, has just been driven by that fear of missing out and some of that cash getting redeployed and people thinking, well, if tech has run up this far and those were the lagging stocks last year, we're just seeing that incremental risk on still taking place. And today we saw a little bit more of a mixed trading pattern, kind of consistent with, well, maybe asset prices have run a little bit high and some players are starting to take chips off the table.
So let's talk about some of the macro background from this week. We saw everything from jobless claims, retail sales, and housing starts.
So we'll kick it off with jobless claims. We saw a lower than expected jobless claim print this week at 228,000 versus a consensus estimate of around 240,000. We had seen claims rise as high as 249,000 back in June. So this is really just underscoring the continued strength that we're seeing in the labor market. And I think is really fueled what we're seeing in, I like to quote this data point a lot, the CME FedWatch tool. So we're seeing this reflected in now Fed rate hike expectations, which have been pushed up significantly higher over the course of the last month. And now we're seeing that Treasury traders are expecting a 99.8% probability of a 25 basis point hike next week when the Fed meets.
Yeah, I think these jobless claims, coupled with some other indicators, are going to force the hand of the Fed to go ahead and give us another 25 basis point rate hike. So, if we transition a little bit from jobless claims and look at mortgage demand, the average 30-year fixed rate mortgage right now on non-jumbo conforming loans, it actually decreased last week to 6.87%, which was down from the previous week at 7.07. Applications for home purchases fell 1% for the week. But what's interesting is they're 21% lower than the same week a year ago. To add some context to this, I know I've given some updates on interest rates over the last couple of months. We're actually starting to see some of the impact in terms of transaction activity on the residential side. As of right now, about 14 of every 1,000 homes changed hands during the first 6 months of the year, which was down from 19 out of 1,000 during the same period in 2019 before the pandemic. So even though interest rates are significantly higher, transaction volume is less. It's not 25% of what it was pre-pandemic. It's still elevated, and I think that's due to, we've had the lowest available inventory on the market. I think I read something this week that said we're at the lowest level of inventory in something over at least a decade. And so it'll be interesting to see as people are locked into sub 4% fixed rate loans and mortgage rates have continued to hover in that 6.5 to 7.25% rate. If this is something that persists over the next quarter, 6 months, or maybe even a year until the Fed maybe starts to pivot and bring rates down.
So turning to retail sales, we saw retail sales rise to a seasonally adjusted rate of 0.2% last month, where the Commerce Department said that this was slower than what economists had expected, and it's still increasing, but we're not keeping pace with inflation. So if we just back up and think about this from the broader perspective, really we're seeing a cooling in consumer spending as consumers are pivoting this summer from spending on goods to services, which is consistent with patterns we've been highlighting for the last couple of months. And really what's, I think, more relevant for the Fed is that there's a very strong argument to be made that the data is showing cooling and that there is justification for a pause, but the tight labor market, as we mentioned earlier, is probably still going to keep them hiking rates by 25 basis points, even though the retail sales, the PPI and CPI prints last week really support a pause, according to some economists.
Stephen, if everything you just said lines up with a cooling in the market, and I think the jobless stuff, we've heard the term recession, and I think we're seeing that played out here, where you have really high-end, high-earning tech employees that have gone, maybe have been laid off or lost their job, but they're not necessarily impacting the employment numbers. And the lower blue-collar service worker, we're still seeing growth in those sectors. They can't find enough labor to fill those roles. So it's really interesting, just that conundrum. I think if we look at headline unemployment, we need to do a little deeper dive and say, like, where is this actually coming from? Because I agree with you. I think the retail sales are another indicator saying that Americans are spending less than what inflation is, or not outpacing. So definitely signs to me that the market is cooling.
And in particular, one number that stood out was that the shortfall in spending stemmed in part from a decline in spending at gas stations. So if we keep in mind that this is a seasonally adjusted number, and that seasonal adjustment is based on historical spending patterns, and namely summer travel patterns. So if we're expecting more consumer spending due to summer travel that hasn't materialized, that's just further proof that there's broader economic cooling, and I think justification for a pause that might not happen. So in my mind, I'm wondering, are we pressing the risk of over-tightening by the Fed?
I think that's where we're at. I mean, we're going to see. They've set a hawkish tone. Now they're going to have to either back off of that, or they're going to give us 2 more 25 basis point hikes.
And last week we gave Trepp's projections for bank earnings, but this week we actually saw the bank's report. Stephen, what were some of those findings?
We had some positive and negative takeaways from their second quarter results. And I think one of the definite positives is that we've seen a trend in stabilizing deposits. Namely, in regional banks, we haven't seen continued outflows. On the negative side, I think a consistent takeaway is that we're seeing higher net interest margin pressures. So let me put this another way. With higher interest rates, banks are having to pay out more on savings and deposits to customers to avoid losing those deposits to other banks that are paying a higher rate. And so that pressure is weighing on this past quarter's results. And importantly, banks are warning of continued pressure going forward. And so that's something just to keep an eye on. I've heard this a number of times over the last couple of weeks, that there's an expectation of some roll up in the banking sector, some expectations that we will see consolidation. Okay, so to dig into some of the specifics, Wells Fargo has seen 14% share price growth year to date. And that's driven by significantly higher net income. Specifically, they've seen a 57% increase in net income relative to a year ago. And their net interest margin has stayed pretty stable, right around 3%. And their deposits on a quarter over quarter basis only declined 1.3%. JP Morgan Chase came out with very strong results. Net income is up 67% year over year, and their deposits actually increased 0.9% quarter over quarter. Citigroup saw deposits decline, and their net income actually dropped pretty significantly. However, the plus side is that their net interest margin was actually slightly higher. So just to recap some of the broader results across the board, again, the net interest margins, what we're seeing if you look across all of the banks is a significant decrease. May not seem significant in absolute terms, but on a relative basis, net interest income is being pressured significantly. So that's where I would think we will see some pressure to consolidate in the banking sector, as some of the lagging banks that just can't keep up with the times, they're probably valued at a very attractive basis, will be acquisition targets for some of the banks that are performing very, very well and where business models align.
Couple of other nuggets here. If you want to sound the news flash sounder, Haley, because this stuff is from Captain Obvious. Banks are warning of weakness in the market for offices. Newsflash. JP Morgan assures that the office exposure is quite small, but doesn't define. And then Wells Fargo flagged a $949 million increase in their credit loss allowance, tied primarily to for office loans. So, we've been talking about the exposure, the upcoming or impending maturities across the office sector. So now the banks are acknowledging that even if they have small exposures, it's going to be pretty significant in the markets, and they're bolstering their reserves to deal with that.
And just to put a number to Wells Fargo, who had one of the largest increase in loan loss reserves, the company had about $35.7 billion in outstanding office loans at the end of March. So if you think about what that means in the context of the marketplace, that's certainly one of the standouts in terms of how much office exposure they have out there.
And something else we saw this week, there was a new report from the Government Accountability Office that found that remote work has taken hold so thoroughly across the federal bureaucracy that many offices are effectively empty.
Another news flash. We've known this for some time, and we've written extensively about this, especially in the DC area where there's a high concentration of federal employee occupied offices, that it's basically a ghost town at this point. But the report stated that effectively most government offices are only 20% occupied. So 24 agencies were surveyed for the study. 17 used an estimate average 25% or less of their headquarter building capacity during the first 3 months of 2023 when the study was conducted. What was even more shocking was that no agency used more than 49% of its office space. So I think 20% is probably optimistic if we're being real. And the reality is, we've mentioned, for us in the data that we track, the government sector represents an outsized portion of the tenant base in a lot of major metropolitan cities. And so it'll be interesting to see if they continue to keep this laissez-faire, work from the office when you want to type of approach, or if we start to see maybe a more stringent requirement for them to have a return to office.
So transitioning over, we had a Trepp flash alert here for the lead cable exposure for AT&T, Verizon, and Frontier Communications. Last week, the Wall Street Journal reported on the toxic effects of lead wiring and telephone lines in the US. So the story was impactful and led to sell-offs in AT&T, Verizon, and Frontier shares, among others. And importantly, AT&T hit their lowest level in 29 years, and Verizon fell to levels not seen since 2011. So the reason why we highlight this is we can draw some parallels to the exposure we saw a couple years ago with the opioid exposure for a particularly large manufacturer that had knock-on effects for their office exposure, namely the cost cutting that resulted had negative impacts on select office properties where they're a large tenant. So Frontier has a handful of loans for which the firm is also a tenant. One property in particular is 1841 Street. That's a $25.2 million loan. The collateral is nearly 300,000 square foot office in Everett, Washington, and Frontier takes 61.1% of that space with a lease ending next year. So that's a candidate where Frontier is looking to cut costs, and they have a hybrid or a low return to office trend that they're certainly going to possibly look to cut space there.
Yeah, I would just say this is from a story in the Wall Street Journal this week. And so if you read the story, basically they're acknowledging that the impacts of this is hard to measure at the point, but we wanted to make sure that we brought this information to our listeners and readers so that they can make their own assessments as they're looking at potentially making trades.
Let's talk about the property sectors. This week we have a lot for office and retail, and we'll start with office. I think firstly, we have a trading alert about a value reduction.
Yeah, so if you're a Trepp subscriber or you're on the Twitterverse and retweet, you would have seen that we posted this trading alert. We've talked about this at length for the last several months, but the value of the Cass Company Tower in LA was cut by 57%. Trepp first reported on this earlier this year that Brookfield was not going to be exercising its option to extend the maturity date on a pair of LA properties, one office and one parking garage, which have ultimately triggered a default on the $350 million mortgage on the property. The most recent servicer data this month showed that the property's appraised value had been lowered to $270 million. The collateral initially was valued at origination in 2021 at $632 million. So you see a significant reduction in appraised value. It also puts the loan underwater if you look at just the CMBS debt, but there's also an additional $115 million mezz piece outside of the CMBS. So this deal, got pretty hairy pretty quick. And we'll see what happens now that the value has been reset to significantly below the loan value.
So just add a little bit more to that, Lonnie. We've been doing some look into office performance and in particular valuations, and the value reduction here, 57%, is pretty consistent with what we're seeing across the board on valuations in 2023, and that we're seeing valuation declines range from 50 to 60%, depending on the age of the building in the metro. So these are really, I would say, skewed toward the negative side relative to some of the headline office value reductions that have been projected by economists and academics. Specifically, I think I've seen this a number of times that office values are expected to decline roughly 40%. And so this is just for market context. 40% is by no means the baseline level, and we're seeing a number of valuations come in significantly more negative than that headline expectation.
And we've been talking a lot about sales comps. This week we had two that we said were brutal. So what's happening in Baltimore?
Sure. These are two office sales reported this week that underscore just how weak the office market is in Baltimore right now. Neither property backs CMBS debt, but the comps could haunt CMBS borrowers looking to refinance debt in the area. So the Baltimore Business Journal reports that 1 East Pratt Street it sold for $25 million. That's down from more than $55 million from the 2018 value, and the office traded for $80.1 million. So this office space is about 356,000 square feet and was 80% occupied according to the report. And then the BBJ reported that 1 South Street sold for $24 million. That's a 475,000 square foot office property that traded for $66 million in 2015. So those comps equate to $70 per square foot for the Pratt Street office property and $50 per square foot for 1 South. So again, underscoring just how significant the weakness is for investors out there trading office properties. Really, really negative comps that we're seeing come through.
Yeah, I think the Baltimore market in general has had some pretty big distress. So I'm not shocked by these numbers. They're really low. If you look at them on a per square foot basis, I mean, regardless of where we're at in the cycle, buying 475,000 square foot buildings for $50 a square foot is got to get pretty close to land value in most of these markets. And so it'll be interesting to see if the plan for the purchase of these is to continue the use as an office building, if it's to raise the building and come back with some newer construction office, or maybe do something else. So definitely something to keep an eye on. And I think, as we've talked about the last couple of months, in some of these markets, these really low sales comps set a new floor for the market. And so we'll see if there's some knock-on effects with some of these other, Baltimore-based buildings that may be forced to sell over the next couple of months as well.
So next up, we have a story about a big Charlotte office loan, and we actually saw that the borrower had a change of heart here, and that's in reference to a deed in lieu. But can you guys break down what that really means?
Yeah, so I know Manis mentioned a deed in lieu last week on the podcast, and we were short on time, so we didn't have a chance to jump in and kind of give an explanation of what a deed in lieu was. So for folks in the industry, you've probably heard this term and understand what it means, but maybe for some of our listeners that are newer to this space, a deed in lieu is basically a transaction where the borrower gives deeds the property back, or gives the property back to the lender in lieu of a foreclosure. So depending on what your state statute is, if you're a foreclosure state, et cetera, you can effectively, as a borrower, say, I want to voluntarily surrender my property back to the lender. I want to forego the foreclosure proceedings and process in place. I mean, it's more of an amicable surrender of the property, but it's not without challenge, and it's not without, some consideration that the borrower should take, under advisement. So you can't just turn the keys in and walk away and say, hey, sorry, I signed for this big loan. I don't want to pay it back. I'm going to give you the building. Let's still be friends. There's still some negative impacts. I think Stephen's going to walk us through what some of that downside risk is for the borrower.
Sure. And some of this comes from what we saw in the 2008 crisis and is still relevant today, both in the residential market and commercial mortgage market. So a real negative for a deed in lieu from the lender's perspective is that if you're just willingly taking the property back and transferring the deed, that's doing nothing to wipe out any other claims on the property. And so if you have a mechanic's lien, somebody performed work on the building but never got paid, they could put a claim against the property that still is outstanding and could actually become the lender's liability if they take that property back. And so in some cases, if the lender is concerned about outstanding claims on the property, really they would rather foreclose and wipe out all of those other claims. So it's very case specific whether or not a deed in lieu is going to make sense. And I would say, the more complex the capital stack, the senior lender might really have a preference to foreclose, and ultimately will, in some cases, as I mentioned, with those complex capital stacks, they will actually have to file for foreclosure just to force some of the other debt holders to come to the table and negotiate their place in line.
Yeah, and this is synonymous with what we were talking about last week, where just handing the keys back doesn't alleviate the borrower's responsibility for the shortfall when the lender sells the property if they're not able to cover the note. It has tax implications. Maybe it saves some of the process, and maybe there's some reduction in potential fees that the lender would come after you as the borrower for. So in some instances, it may make sense. So it's interesting when you gave us the intro here, Haley, that, the borrower on the Charlotte office had a change of heart to kind of bring it back. So earlier this year, we wrote a story that Wells Fargo was going to be vacating the one Wells Fargo Center and two Wells Fargo Center, both in Charlotte, pointing out the Wells Fargo Center was backed by about $160 million 301 South College Street loan. But it looks like at this point, the loan has been sent to special servicing because the balloon date was missed. And special servicer had notes in the system that they were hopeful a maturity extension was being negotiated. But in July, the servicer commentary switched and said that no longer are they considering an extension, but now they're looking at foreclosure. And in the commentary, it also said that the borrower had potentially expressed interest in conveying title back to the lender. So that's where we would get the deed in lieu. So this is one we want to keep an eye on over the next couple of months to see what happens, because sometimes deed in lieus break down and the lender ends up having to go through with the actual foreclosure process.
And we'll pause for a moment with a message from our sponsor this week. This episode is sponsored by Better Pitch, the experts in private equity pitch deck design. Whether you need a fundraising, corporate overview and track record deck, or investor reporting collateral, they have you covered. Better Pitch has developed pitch decks for raises as small as $1 million and as large as $500 million. The best part? Better Pitch completes all design, copywriting, and market research. Better Pitch is the plug-and-play option to deliver an institutional quality deck, and they deliver the final product in a PowerPoint file for you to use on future deals. Visit betterpitch.com today to learn more.
So turning to another trading alert we had this week, suburban Chicago office loan goes 30 days delinquent, and the borrower is looking at turning the property over to lenders possibly. So according to July servicer data, the $114 million Riverway loan has gone 30 days delinquent for the first time. The collateral is an 870,000 square foot office complex built in 1988 and renovated in 2016. This is a loan that's split across two CMBS deals. Occupancy at this property dropped from 91% in 2019 to 67% in the first quarter of 2020 after the second largest tenant, the Central States Pension Fund, vacated. And that tenant had about 21.9% of the space.
Yeah, this property has some, not so great debt service coverage. It was just 0.60x when the occupancy was at 60%. Occupancy has ticked up recently to about 68%. That's according to data from Q1 of 2023. And so we'll see what happens here. This is another one where the borrower has inquired about turning the property over to the lender. So we'll see how this plays out. I was optimistic last week. We had a really great green shoot hotel story in Chicago, but this is another crabgrass for sure here in the suburban Chicago office market.
This week, we also saw two large office loans heading to special servicing.
Yeah, according to July data, the $212.5 million Tower Place loan in Atlanta was sent to special servicing and had missed its balloon date. So this is another example of an office loan that's unable to refinance in the current environment. This is a 790,000 square foot office property at 3340 Peachtree Road Northeast in Atlanta, one of the 20 Peachtree roads that exists in Atlanta. The loan was originally slated to mature in July 2021. And the borrower exercised two contractual 12-month extension options, which pushed its maturity date out to this month. And there were no more maturity extension options remaining. So servicer data showed that WeWork was the top tenant with 10.7% of the space, with a lease that runs until 2032. However, there are several other large tenants that have leases slated to expire over the next 2 years. This is a classic case of an office property that's already probably has a small subset of lenders willing to lend, but where there's just big questions that have to be answered before anybody is willing to lend funds. And namely, those near-term lease expirations have to be figured out before any lender is willing to step out and refinance this property.
Stephen wasn't joking about the 20 Peachtree roads there in Atlanta. I was actually down in Atlanta this week and got very familiarized with why they call it Hotlanta. It was quite steamy, but I was fortunate. I was doing a presentation for the Mortgage Bankers Association there, and the event was hosted at the new Atlanta Braves Battery mixed-use development where the stadium is. And I'll tell you, it was really, really nice. They did an incredible job with that. And the office buildings in that center, according to some of the folks in attendance, were almost at 100% occupancy, and the leasing velocity across the retail space and the multifamily space was off the charts. And so it just goes to show that even with some of these negative stories, there's still a lot of really positive news and activity taking place in selected markets. Does this building, again, cause some other downstream implications for the Atlanta market? I know when we put out some sublease mapping and stories about 6 months ago, Atlanta was one of the top 10 cities in terms of sublease space. And so we'll see what happens here. My estimation is this is another one of those really big deals based on loan balance, et cetera, that probably gets some sort of post-maturity extension just because nobody really wants to take this property back. We'll keep an eye on this. If anything changes, obviously, we will report it to you first on the podcast or through our TreppWire publication.
I mean, this is a tale of two Atlantas. You're talking about the northwest submarket near the Brave Stadium. And I would say the suburbs are performing a lot better in some cases for these office properties. If you just think of, this is probably an additional 30 to 45 minutes commute potentially between where that submarket you were talking about is located in northwest of Atlanta on that outer loop of 285 and 75 on the northwest side versus downtown. And so given that the suburbs constitute really a major portion of the commuting employment base, I think that's really not surprising to me, just being familiar with the area, that you're seeing some good strength around a suburban office submarket with a lot of amenities. It's amenity rich.
Yeah, can I throw a little shade at Atlanta though? That airport there, disaster. I mean, they got one entry point for all drop-offs on the departure side. You got to ride the train into the terminal. It's the most confusing. The signs don't make sense. I mean, I'm not the smartest guy in the room, but I'll tell you, every time I go to the Atlanta airport, I'm like, I don't want to fly back into the Atlanta airport. It's ridiculous. And the traffic there is kind of, in Atlanta broadly, is every time I've been there, there's been crazy traffic in the middle of the day, which just doesn't fit the narrative with what we're seeing on some of the CRE stuff. So I'll get off my soapbox, but I think Atlanta is underrated as a potential like big metro city. Like I think it has all of the fundamentals to be more prominent in the CRE discussion than it is, but the airport and the traffic, not a fan.
One more point here that I have to throw out is one thing that I'm curious about is you've seen a large amount of Hollywood production move to Atlanta. I mean, the movie and TV show production growth that you've seen in that city over the last 20 years is really, really significant. And so with the writers' strike and actors' strike going on right now, part of me wonders, what kind of an economic impact that could have for the Atlanta area.
So Haley, I know we had two office stories that were potentially going to special servicing. So we spent a lot of time on the Atlanta office. So I'll quickly hit the Dallas office story here. But July servicer data, there's about a $57 million Hall office portfolio loan that's been sent to special servicing. This loan backs two Dallas area office properties. The first property is 142,000 square foot, what they're calling building E1 property at 3010 Gaylord Parkway. That's in Frisco, Texas. There's another building about 154,000 square foot called Freeport 9. That's at 4609 Regent Boulevard in Irving, Texas. And so just another crabgrass story for office properties in another major metro market in the Dallas-Fort Worth area.
Let's move on to retail. We saw a mixed bag of stories this week.
So first up, we have a Las Vegas mall that missed its balloon date and modification is being discussed. So July Trepp data revealed that the $118.7 million Meadows Mall had missed its maturity date, and special servicer notes indicate that modification discussions are continuing and that a deal could be reached in Q3. So a real green shoot, I would say, considering that this is a mall. So this is a 300,000 square feet of retail space in Las Vegas, Nevada, with a couple different pieces spread across few different CMBS deals. And for 2022, this loan posted a debt coverage ratio of 0.92 with occupancy of 89%. So relatively strong occupancy. Obviously, that's supporting probably the bar's push to modify this deal with expectations that they'll get above 1.0 in the near term.
Yeah, we're going to maybe have a slight disagreement in green shoot or crabgrass on this one, Stephen, because I'm looking at 0.92x and saying this thing's not making it. And if you look at the collateral value, it was valued at origination at 235 million, was later lowered to 95 million, now down to 89 million. And the loan was about 119 million, as you mentioned. So I love your optimism, but I'm gonna have to take the opposite side on this one and say they're trying to do a modification because the lender does not want this back. I don't see how occupancy is roughly 90%. You're still not at a 1.0. Not much upside on this deal.
Like I said, it was relative for a mall. So maybe positive from the borrower side that they're going to try and extract some concessions here.
Fair point.
So next up, we have a trading alert for a big Jacksonville retail loan that was extended to 2026. July Trepp data revealed that the $110 million Avenues loan had been extended. This loan missed its maturity date in February 2023 and had been in special servicing since last November. The loan is now being reported as current with July special servicing data, And this is a 600,000 square foot retail property in Jacksonville, Florida. So the new term pushes it out to 2026. The debt coverage on a net cash flow basis had been strong, 2.83 over the first half of 2022 and 2.76 in 2021. However, occupancy had been below 70% since 2019 when Sears closed at the property. The value was $244 million at 2012, giving the loan an LTV of 45% at the time.
Yeah, there's been a lot of stories in the news this week, and we're going to actually talk a little bit about some of the syndication stuff here at the latter end of the podcast, Stephen. But what are your thoughts around looking at static LTVs based on origination? I mean, like, obviously, I'm more of a proponent that we're going to look at in-place value and current loan balance, but I know there's been some discussion over the last week, and we'll talk a little bit more at length. But just quickly, are you a proponent of looking at static LTV as some sort of a proxy, or are you more in real time? What is the value and what is the loan balance?
When I look at those static LTVs, really what I'm looking at that for is how much equity or skin in the game did we have at origination? How conservative was that loan? So to your point, really what I care about is where values are at today. And so I could think, well, if values declined roughly 50% since 2012 on this asset, there's still some positive equity. So you can do some very broad brush, quick back of the envelope analysis just to say, okay, if I really want to beat this thing up, I mean, is the borrower underwater or not? And what's the likelihood of this loan ultimately making it?
So that leaves us with one more retail story for this week. And this is back in Texas and my stomping ground. So July remittance data shows the $64.9 million Arbor Walk and Palms Crossing loan was actually paid off in full. So the loan was slated to mature in August of 21. It did not pay off, and a modification which extended the loan to August of 22 was enacted, was then pushed out another year, but it effectively has been paid off in July. It was about 80% of the collateral behind a 2011 Wells Fargo deal, and it was split across two retail properties. The larger property was the Arbor Walk Retail Center in Austin, which is about 465,000 square foot. And then there was a smaller 328,000 square foot property in McAllen, Texas. In 2022, they had debt service coverage of 1.2x and occupancy was 93%. After a downturn in 2020 due to COVID, where occupancy fell to a low of 81%. So this is definitely a green shoot, given that they had to extend the loan for 2 years post maturity. And it finally got paid off with the $64.9 million payoff.
So you mentioned multifamily syndicators, Lonnie, and last week we talked about this in depth after the Real Deal article. But this week we used our CRE product Trepp loan to examine the loan exposure for 5 of the multifamily syndicators that saw significant growth over the last few years.
Sure. So both Bloomberg and the Real Deal had reported on this, and one of the last stories to be reported was from the Real Deal, where they were highlighting 5 particular syndicators: Tides Equities, GVA Investments, Inteya Capital, ZMR Capital, and Rise 48 Equity. So what we did was we looked at these 5 sponsors and their exposure across both CMBS and CRE CLOs. What we found was a total of $3.6 billion in multifamily CRE loans are outstanding to these 5 syndicators with maturities of 30 months or less. So why this is important is when we dig into the numbers a little bit here, a strong majority, specifically 96% of this exposure, is floating rate. And the weighted average debt coverage on that floating rate portion is right at break even. It's 1.04. So there's a significant number of properties here that have negative cash flow. And so just to back up here, the strategy of the syndicators in large was a value add. A number of these syndicators were looking to acquire Class B or older properties that could benefit from some capital improvements where they thought they could push rents up and really ride the rising wave of rent growth and flip these properties quickly. Well, what we're seeing is that while some of the repairs have gotten completed, the rent growth hasn't panned out to be as strong as what they expected. And if we think about, just put yourself in a renter's position, thinking about, well, do I want to take space at a new property or rent something that's been recently renovated? Well, if those recently renovated units are leasing for about the same price per unit, chances are you might be biased toward the newer property with better amenities. And so these older value add properties are really struggling as new supply has come online. And what we're seeing is, and this is a classic case of underwriting at peak market, and you're going to have really some pain to be expected with across these 5 syndicators. Obviously, they're not all equal. Some will probably turn out relatively okay on balance, while others will really struggle to get out of these loans and make their investors whole on the recouping principle on the back end.
Yeah, the number that jumps out at me on this one, Stephen, is a 96% of the loans are floating rate, and the weighted average debt service on those is just over 1.04. That means to me that some of these properties, not all of them, but some of these are going to go back just because they're not going to be able to execute. You know, I've said this before on the podcast, everything around value add and these multifamily upclassing of buying a 1970s vintage Class C and turning it into a Class B based on rents and upgrades, et cetera, is great. And it works until it doesn't. I mean, the reality is for all of these operators, there was nothing inherent about their value add strategy that gave them a competitive advantage in the market. It was just market timing, overall sentiment, and their ability to push rents. And we're seeing that play out now. The interest rates on their face are really wiping out the upside on these because they're not seeing the rent growth that they had underwritten. And just, you know, as somebody that's a little bit skeptical, given where we're at in the cycle, you know, everything that's been purchased, you know, call it in the last 18, 24, 36 months, even in selected markets, you just have to question those underwriting analysis that was done on those at those property levels. When you're estimating double-digit rent growth over a hold period, it's really hard to achieve that. And I don't think people acknowledge the risk of expense creep, and we're seeing that across taxes, insurance, employment, you know, personnel, et cetera. And so even if you achieve a 7 or 8, 10% rent growth, doesn't mean that tracks all the way down to your NOI line. And so these people are finding the hard way that is how this game plays. I'm hopeful for their investors and for them that they can figure out a way to survive this. And it can be something that the market looks at and says, wow, we really escaped some potentially bad news. But unfortunately, when you look at the data, I think there's definitely going to be some of these properties that just have to trade at a discount. They're going to get wiped. The investor's going to lose their equity, and hopefully somebody can come in at a new basis and make them viable.
So if you want to get a copy of the Multifamily Syndicators Report, please reach out to us at podcast@trepp.com and we'll send you a copy. Lonnie, I'm glad you mentioned the expense creep, because that's another one of the reports that we have coming out here. Is we're doing a series on property expense growth and breaking it down, not just from the overall expense number. That's the first report that we're publishing, but we're also drilling down into each of the major individual line items, from real estate taxes, insurance, utilities, so we can get a granular picture of what's happening across various markets throughout the US. So the part 1 report that we're releasing is looking at the year-over-year change in the operating expense ratio. And what we've done is we're presenting not just the year-over-year change in operating expenses, but also revenue and net operating income. So you can get a picture of really what that expense creep looks like, both from the operating expense level, but also what that means for the bottom line. And so topping the list for markets that had the largest change in the operating expense ratio on a year-over-year basis. So this is a good thing, and that your operating expense ratio is declining because your revenue growth is outpacing your expense growth. So the top 5 markets here are Birmingham, Alabama Metro, Las Vegas, Seattle, Salt Lake, and Phoenix. And just to call out a couple of markets in particular that had extremely strong revenue growth year over year that outpaced operating expenses by a large margin, was Las Vegas, Salt Lake City, Phoenix, and Tampa. All 4 of those markets had low double digits growth in NOI, and that was driven obviously by revenue outpacing expenses, but you're still seeing very high expense inflation, high single digits, and in some cases, for certain markets, it's low double digits growth in your property expenses. So on the flip side, some markets where revenue was trailing operating expenses, and so you had that operating expense ratio creep up. The top 5 markets: Buffalo, Minneapolis, Providence, Oklahoma City, and Virginia Beach. All of those markets saw pretty significant margins with operating expenses outpacing revenue growth.
A lot of those in the second tier that you talked about where expenses outpaced revenue. Secondary markets, probably where values have gotten pushed significantly above what they should be. What did we call that? Irrational exuberance, I think. And you probably have less sophisticated operators in those markets. I mean, I think one of the benefits that these larger operators have is just the economy of scale that they get with owning multiple properties across multiple markets. That helps with their vendor relationships. That helps with their ability to manage some of the expense creep that the smaller syndicated mom and pop type of owner operators just don't have the capacity for. So maybe in a follow-up for this piece, we might be able to look at, how does ownership size or scale impact these metrics that we're measuring here? Because I definitely think the larger players, while still impacted, are probably impacted less on a relative basis than the smaller single property type of owners. But if you're interested in this report or what's coming out around this is going to be part of a series. Again, reach out at podcast@trepp.com and we'll be more than happy to get that sent over to you as soon as we can.
So we have a few programming notes before we close today. Next week on Wednesday, July 26th at 1 p.m., we are actually hosting our next Market Pulse webinar featuring Lonnie and Steven. So these webinars are another way for us to reach our audience, update them on what's happened during the month, and we always reveal some interesting data or trends that we're watching. Send us an email to podcast@trepp.com if you want the registration link. And speaking of more content, this is something new. So the TreppWire teams are looking to expand our offerings. So what we're asking today is for you, our listeners, to reach out to us and let us know if you'd be willing to hop on the phone with Manis, Lonnie, Steven, or myself to discuss ideas for growing our footprint. So we'll probably take the first 20 to 30 loyal listeners who reach out, and we'll schedule some calls with you for August or early September. We promise this is not a sales pitch. We are really trying to determine what we can offer more of, where the market feels they're underserved, and where we can add more value to the CRE market as a whole in terms of content and news and podcasts. So our lines will stay open until we get those 30 people, but we will also have a survey that we can send you. So if you're more interested in a survey, let us know about that too. So send us an email to podcast@trepp.com, and we look forward to speaking to you all and hearing your feedback and your thoughts for us. And turning to shout outs, we had a lot this week, so I'll run through them quickly. Andy B mentioned that we should provide an update on CMBX and also do a deep dive into what it is. So I wanted to remind our listeners that we've covered this a lot in the past. We have several blogs and reports and podcasts about CMBX 6 and 7 specifically, but we will also keep in mind that we could do a deep dive into certain parts of the market like that. So we'll talk about that in a future episode, and you could always reach out to us if you want any of those resources. Gary N. discovered the podcast a few months ago. He said he works in commercial real estate banking, and he gave us some additional color on the story we spoke about last week about Deloitte moving to the Winthrop Tower. Paul Murphy said he's a new listener and he loves the pod. Brett M. actually sent us a GIF and said Olive Garden plus defeasance equals gold. So that was some of what we chatted about a few episodes ago. Brad C. said, great podcast. Mark H. said, you guys really understand the best game, which is real estate. Mike S. said he was listening to the podcast while on his paddleboard in Monmouth Beach, and he loves listening during his weekend paddleboarding sessions. So that every week we say we have a first, and that's definitely a first. Carla L. said she loves the podcast and listens every week. Pierre L. said he wants us to bring the podcast to South Africa and do a live show from one of their magnificent game reserves with lions roaring in the background. And he even invited Simon H. So that's who we frequently mention as our CFO. So Pierre, we'd love to make it out to you, but very cool to hear we have a listener in South Africa, and thank you for the shout out. Matthew F. reached out to me on LinkedIn and thanked us for our podcast. Tom I. listens on YouTube, and he said, while Olive Garden probably won't get any Michelin stars, he's always happy to visit it. So we do have some fans. Then we had Jason J, Mike P, Chris W, Jason M, Laura S, Richard R, Jack M, Jason P, and Carolyn N also reach out. And then a few people on Twitter, Donut Shorts, gave us a shout out for some of our CMBS coverage from last week. Jeff F also commented on our BBB minus spreads conversation, and he wanted to know, is the end of year activity up? And Lonnie, I know you were speaking with Bo B on Twitter as well.
Yeah, so Bo reached out and asked me to be a guest on his podcast earlier this year, Commercially Speaking. I joined, great guy, know Bo. He's a broker in the Kentucky area, CCIM, done a couple of presentations with his group. So great to give him a shout out. You could check out his podcast. It's a fairly new one, talks about commercial real estate. He has his brother that's an actor on, and the gist is you bring a CRE expert on. At the end of the podcast, his brother has to answer 3 questions, and he doesn't know anything about commercial real estate. So it's a pretty cool concept. So thanks for listening, Bo. Thanks for the shout out, and hopefully you get some new listeners from our podcast as well.
And a final shout out to Manis, who's just out of office this week, or just today, but he'll be back next week. So thanks, Stephen, for jumping in.
Thanks for having me.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening, and stay well.
All right.